Hey everyone, this is Kirk here again from OptionAlpha.com, where we show you guys how to make smarter trades. And welcome back. And in today's video, we're going to cover all of the closing and adjusting trades that we made for July 11th, Friday. It was actually a pretty fair or a pretty busy day for us, even though we had no new opening trades. We were pretty aggressive with the adjustments to our UAL strangle, and so we'll go over that at the end of the video, talk about that in depth and our whole strategy heading into this last week of expiration for that trade. But first, I want to cover some of the closing trades that we made here on Friday. And the first one that we closed out of is OIH, and that is one of our put butterfly spreads that we had for OIH going into July. Now, this one was a little bit weird because we actually traded an August weekly on the long side instead of just a regular August monthly contract. So we had the July, which we were short, the July monthly contract for the 55 put, but then we were long the July weekly contract for August. So a little bit shorter spacing in our calendar spread than we usually do. And that was just, we were trying to take advantage of nice pricing that we saw in the weeklies versus the August monthly contracts. So, but at the end of the day, we ended up closing this one out basically a scratch. It was a $10 profit basically, and not even making money after commissions is all said and done. But the whole idea here is that it took a little bit of time for OIH to actually turn around, and we held this one pretty long to see a nice little profit in OIH. You can see this is a chart of OIH, and the stock just continued to rally most of the month and then started to finally turn the corner up around 58 and started to head back down. But remember, our range that we wanted to be in by the end of next week is right around 55. So it's definitely heading in that direction, but saw an opportunity to close this thing out at a nice little profit and get this one off as a scratch, just a means to stay active during this low implied volatility time. The other trade that we closed out today is Amazon. Now, Amazon's a real great story because those of you who have been following along and did our hedge from last week, we had originally entered this spread as a broken wing butterfly, and I'll go over all of this here in a second. But we originally entered this spread as a broken wing butterfly, hedged out of the broken wing butterfly, and basically made a no risk or risk free butterfly, anticipating that at some point maybe Amazon might rally back towards our 345 middle strike. And that would give us an opportunity to make a nice chunk of change on this, right? It was basically a lottery ticket, whether Amazon did that or not. That was really just kind of a guess on our part. And what we did is closed out that butterfly or hedge that butterfly to take in a small profit, but also to leave this small window of upside potential. And I even mentioned in the video that sometimes these hit during the year, and I've had numerous occasions over the past couple of years where I'll do this constantly, where I hedge out of this broken wing butterfly, leave this lottery ticket butterfly on that's very even and risk free, and 5 or 6 times during the year this thing will hit and we'll have a nice little profit. And that's exactly what happened here, is that we turned a trade that we were going to make about $40 and made about 105. So it was a nice little hit on our part. And just luck of the draw, I guess, with the market. But we ended up selling out of our Amazon 340, 345, 350 call butterfly. We sold it back to the market for a 70-cent credit. In total, after all of the hedge and everything, we made a $105 profit. So not too bad on just a one-lot trade and very little risk. If I actually go to the chart here of Amazon before we actually go to the pricing chart, you'll see that pretty much for the entire month it was trading right around the 330 area and kind of had little ups and downs, etc. And what we did is we had an opportunity, because we did the broken wing butterfly above the market, to then see this decay in the value of the options and gave us an opportunity to hedge out of that just a couple days ago. And when doing that, we also left an opportunity that Amazon closed anywhere around 345, and you can see it closed at 346 on Friday. That gave us a great opportunity to close this thing out and bank a little bit of money, a little bit more money than we usually would with these broken wing butterflies. So here's the actual trades that were executed, and you can see on Thinkorswim, I've gone back about 60 days in my account just to capture everything for Amazon. 3 orders, 3 fills, just so you guys can see kind of the trade history that we had. So back on 6/12, we entered this broken wing butterfly, the 340, 345, 355, skipping over that 350 strike for a $60 credit. And we went back in just a couple days ago on 7/8 and bought back the embedded spread, which is the 350, 355. So now we don't have this 355. Now we went to a regular, very even butterfly, 340, 345, 350. That cost us, of our 60-cent debit, about 25 cents. Then today we were able to sell back the entire spread that was left for a 70-cent credit. So the total credit and everything for the whole trade was a profit of about $105. So again, just want to show you guys what this opportunity gave us. It was a lottery ticket. Sometimes they work, sometimes they don't. If nothing happened, if this trade that we had closed out of today, this butterfly spread, had never really come to fruition, then we would have made the difference here between our credit and our debit. Still made a profit, but we left an opportunity on the table to make a little bit more money. And I think that's a great way and a great example of not only hedging, but hedging to increase your profits, right? We usually talk a lot about hedging, and you see a lot about hedging to reduce loss, which is obviously important, but sometimes people don't cover enough talking about hedging to actually increase the potential for profit and decrease risk. So great story on Amazon. Wish we would have done more of them, but we didn't. So it is what it is. All right, so let's head down to UAL. So UAL has been obviously the one that's tying up a lot of our capital right now because we have a very, very big position in UAL, and that's okay. This is what this opportunity is here for. You have these opportunities during low implied volatility times where you do very small trades in Amazon and calendars and debit spreads, etc. But then when you see an opportunity like this, you've got to be a little bit more aggressive. Now, whether it works out or not doesn't matter. Really, our idea here is that we want to be really, really aggressive and take in a lot of credit. That's the name of the game with these trades. As they start to go against you, especially these strangles and straddles, your whole goal should be improving your credit position, meaning taking off positions that are worthless or near worthless and rolling those up to positions that have more value, therefore taking in more credit. And you can see with both of the hedges that we had in UAL, we took out our lower strikes, which is the 44 puts and the 33 puts, and rolled those up to the 46 puts on both ends. So we have 6 short contracts at 46, which gives us a very big position right below where the market's trading right now. That obviously sells a lot of premium that's extrinsic value or value out of the money. So it's all time and volatility value, which is going to decay extremely fast over these next couple of days as we head into expiration. So the name of the game here is to continue to take in credit, which we did. We've got a pretty massive credit building on UAL. As far as where our position is concerned, you can see that UAL has been moving non-stop higher for the last 3 days. Implied volatility still remains high, so all of this selling of these credits is still really, really good, right? We have a great opportunity to sell high implied volatility, obviously because the stock is making some pretty huge moves, right? So what we wanted to do is continue to sell a premium, take in this massive, massive credit on UAL. This is what our profit loss diagram looks like at the moment with the positions that we have on. It does not include, as I've mentioned a number of times before, but I'll talk about it again. It does not include any trades that we've closed out for a profit. So all the times that we've done adjusting and rolls have been banking those profits on those individual strikes. So that doesn't include this in the profit loss diagram, but basically this is what we're looking at is a very wide strangle in UAL. Now UAL is trading right up here along the top edge of the strangle, and that's okay. So if we get into or closer to this week and we start to see UAL trade higher, then all we're going to do is take a profit again on our 46 puts that we're short 6 of and roll those up to 47 or 48, whatever the case may be, and continue to take in a credit. Because at some point, this has to move a little bit back down, and that's going to start to decay all of these options as we head towards expiration. I think in total, our credit that we have right now for UAL is somewhere around $2,500, so $2,500. So as long as we can buy back all of these options after it's all said and done for somewhere around that price, I'd be very happy. If we can turn a profit, that'd be awesome. If we can turn a small loss or a scratch, that'd be great too. But that's our whole strategy with UAL. Continue to take in premium. And obviously at the end of this expiration week, once we get done with expiration with UAL and wherever we end up, we'll be doing a huge video tutorial and probably a presentation and a blog post just kind of outlining all of the individual trades that we made. Because there's been a lot of trades. We have a very large margin balance on UAL, but that's okay because we have this as our one and only strangle that's in the portfolio. No, excuse me. Correct me. We have a WAG strangle, but it's very small. But this is the one that's really taking up a lot of our margin power. But that's okay. We've got definitely some dry powder to use up with this trade. So as always, I hope you guys really, really enjoy these videos. I know we definitely covered a lot in this video tonight talking about UAL and Amazon and OIH. Now remember, these videos and alerts are only sent out daily to our members at optionalpha.com. So after about 15 days, we unlock them and open them up to everyone publicly. This means if you're not a member with us already and you're watching these videos online somewhere, you're about 15 days behind the 8 ball and you're really missing these real-time updates. The good news is, obviously, you can test out everything we have and take it for a test drive free for 7 days. Just go ahead and go to optionalpha.com, click the orange button right on the home page. You can get all these alerts and video tutorials real time. Again, if you guys have any comments or questions about the trades we made today, let me know. Add your comments right below here in the comment section. I'll be sure to get back to each and every one of them before the market open, and happy trading.